But yes, let's talk more about markets and, of course, how it looks like for the medium to long term and how you should build your portfolios going ahead. Let's go across to my next guest of the show. We have Harshal Dasani, who's the business head of Investec PMS, joining us. Harshal, good afternoon. So good to have you back once again. And, let's discuss more about markets because today we have closed in the red. But we have seen the kind of pullback from March lows, not just on the benchmark index, but from the broader end of the markets, which has seen a stunning recovery. But what does this rebound tell us? And given the kind of tensions which is yet to get resolved between US and Iran, because they're yet to go around that second round of negotiations. So what's the thing that you're watching out for?
Good afternoon, Lavisha. Thank you so much for having me, and good afternoon to viewers as well. The markets, as you rightly mentioned, the markets are currently pricing in the expiry that is coming in the couple of days on the Iran and US ceasefire front. But what I personally think right now is, if you see markets, if you look at Forex, if you look at everything right now, everything is revolving around crude. And I think crude itself, which was on a rise for the majority part of the last month, is now on a cooling side. I feel that crude finally right now has turned on into a sell-on rise, and the markets, you are able to see the buying that is coming down into the markets from the lower levels. So I think that yes, uncertainty is still around there, but I think crude anywhere getting stable below 90 levels is going to be very beneficial for the market. But the uncertainty still stays. Overall, I really feel that the markets have, I think, bottomed out. There may be a certain downside that may come in with the uncertainty that may be announced in the next couple of days. But overall, I think that till crude is hovering between 90 to 85 levels, I think the markets have formed a base. They have done their consolidation, and I think they're ready to move into the next leg of the rally. But overall, the developments in the next couple of days are going to shape the markets ahead.
Okay, got it. Harshal, how are you viewing the current valuations? I mean, despite the reset, we have seen that FIs continue to remain on the sell side, though the quantum of the sell-off has tempered in the last couple of sessions, but we are yet to see them buying consistently. Is their return kind of far-fetched now the kind of growth in inflation risks have emerged out of the energy supply disruption?
Well, I think FIIs, it's a great time for them to come back again because you see USD INR is at its record high, I think 92, 93. So I really think that the FIIs, after a huge sell-off in the month of March that they had during the Iran-Israel war, I think that it's the time for FIIs to come back because if you look at Indian markets in comparison to the global markets, you see right now, all the global markets from the September 2024 highs, they have been outperforming. You look at Korea, you look at Taiwan, you look at probably Japan, you look at NASDAQ and Dow Jones, they're all hitting their new all-time highs. Whereas if you look at Indian markets right now, Nifty is around 7% down from its all-time high. The mid-cap index is down a couple of percent and the small-cap index is down in double digits. It's like around 11-12% down from its all-time high. And I think the Indian markets are also trading at I would not say at a very cheap valuation, but they are trading at a good valuation in comparison to the global markets and peers. Nifty is trading below the median PE of 22. So I think overall, the Indian markets have somewhere bottomed out. And I think we have a good flow of news right now. The only concern right now is the FIIs selling out because of the high USD INR. But if you look at the other side of the coin, the high USD INR also gives them an opportunity to put in money into the Indian markets because you see, when you look at FIIs, their major concerns is whatever returns they make. In the rupee depreciation, they lose a major chunk of it. And currently, if you look at USD INR in the last 1.5 years, the kind of depreciation it has had, I don't think that there is too much of depreciation left ahead because if you compare USD INR today to the global currencies, right, the dollar index is down around 10% from its all-time highs. And the dollar index is versus all those countries that are going through a stagflation. Europe is in a slowdown right now. So dollar inherently is getting weak. But if you look at it in terms of USD INR, it is getting strong. So I don't think that that is too much sustainable in front of an economy that is growing at around 6-7%. So overall, I think that USD INR is bound to cool down in some time, and we're not expecting any more big depreciation coming in unless the war spikes up the crude above $150. That is where our forex reserves will be depleted very quickly. But overall, I think that USD INR somewhat has done what it has to. And I think there's a cool off expected anytime soon. And once the cool off is expected, once the cool off happens, the FIIs are expected to pour in their money back and the Indian markets look quite attractive.
Okay, got it. But at what, rupee dollar currency that you're watching out for, do you think that FIs can make a comeback? And of course, in terms of the oil price as well, because I mean, earlier on Friday, we fell to about 86 against the US. $86 per barrel, but we are back above 95 again.
Correct. So I think USD INR should cool somewhere below 91, 90 levels for the FIIs to really come in back. But if you look at the crude oil prices, okay, the crude oil prices gave that jerk on the Friday on the expectation that the state of Hormuz is open, everything is okay, and now things are about to get back to normal. But the ceasefire was violated over the weekend, and then you see the crude oil prices spiking up again back today morning. I think until crude oil is below $100, the markets are not going to see a panic sell-off anymore. We are not going to see those couple of percentage dropping in the small cap index or the Nifty right now. I think above till it is above 90, you're not going to see an upside move coming, a massive upside move coming in. So the crude oil between 90 to $100 is going to make the markets in a consolidation phase. But once it slides below the $90 mark, somewhere between 80 to 90, that is when we are expecting the markets to pick up the rally and break off from their all-time high following the global markets. But until it is ranging above $90, it is going to be very difficult. On Friday, we were all expecting that the crude oil, when it had spiked down, we were all expecting a good gap of around 300, 400 points in Nifty. But it didn't sail through because the ceasefire was not done. So I think that as soon as the crude moves below $90, it is going to open up the doors for market to move higher and the Nifty to break their all-time high. But till it is between the range of 90 to 100, it is going to take some time for the markets. They are going to be in a healthy consolidation phase here. And probably once any side, you see above $100 crude spikes, we are expecting a fall in the market. Below $90, it should, just start moving up.
Okay, all right. So from a rupee point of view, you're seeing 90 to 91 as a threshold for FIs to make a comeback, and from a Brent crude, it's 90. Okay, all right. Let's deep dive into the earnings season also. We've had two banking majors reporting their March quarter performance. We have seen a steady quarter from both of them. I mean, ICICI Bank was fairly seeing a stable asset quality from both the lenders. But what about HDFC Bank? It's a muted Q4 for them. And what are you watching out going ahead in terms of growth and, of course, from the next couple of quarters?
If you look at HDFC Bank, the merger that it had in 2023 between HDFC and HDFC Bank has bloated up the balance sheet of HDFC Bank, and it has also messed up around with the loan to deposit ratio of the HDFC Bank. But right now, if you look, I think deposits are fairly picking up and the credit growth is also stable. The deposits are growing faster than the credit growth for HDFC Bank. So I think that is very positive for HDFC Bank. But if you look at it in terms of price, HDFC Bank has closely given negative performance in the last 4.5 years. And HDFC Bank has not really performed that great, whereas ICICI has been stable and it has been doing great. But I personally feel that this quarter was not really about showing the growth. It was about how resilient the banks could stand and face the pressure. I think HDFC Bank and ICICI Bank overall, in fact, not only banks, these two banks, but I think overall financial space as the sector is about to enter into a structural up move. It has been in a strong consolidation for the last few years and their valuations were a little paced up a couple of years back. But now I think with the top line and the bottom line picking up, the valuations are now also in control. And I think anytime we should see an up move triggering in them. I think once this uncertainty plays out, the Iran-Israel war, I think banking will be one of those sectors who will lead the further leg of this rally.
Okay, got it. That's the view. But, in the financial space, what would your be preference? I mean, is it the private lenders, PSU banks or NBFCs? Today, we did see PSU banking index doing well on account of the Bank of Maharashtra Q4 performance. What's your pick amongst the three?
Well, if you ask me, I am not very skewed towards the private banks, but I think PSU banks can do really well. As you saw the Bank of Maharashtra's result, I think PSU banks, even after a good performance, if you see private banks, HDFC, Kotak, Axis, ICICI, they've not given a great performance in terms of price for the last few years. PSU banks have already performed well in terms of price. You look at SBI, you look at Canara Bank, you look at Bank of Maharashtra or Union Bank, they have done great. But I still think that they are still undervalued in comparison to private banks and they have more room on the upside than the private banks. Well, in case of private banks, I would be looking at the small cap private banks that are between the market cap of 5,000 crores to another 25, 30,000 crores. So I think in the finance space, PSU banks are going to be number one. I think they're going to lead because their books are building up amazing. They have a double-digit growth up there, and I think they're still undervalued in comparison to the private banks. So PSU banks, on every stellar result, you're going to see an up move. You saw Bank of Maharashtra right now; it shot up by around 5-6% as soon as the results were announced. So I think PSU banks are going to do really well. After that, I think the private small cap banks, they are going to do fantastic. Something like your DCB Bank, any small cap private bank who's building up their books and the growth is proper. And I think a major factor for this is also going to be the size. So private banks like HDFC, Kotak, they're going to do well because they've not really performed for the last 5 years and the books have improved. But if you were looking for growth, then PSU Bank and small cap private banks are your space.
Okay, all right. PSU banking index, PSU banks is something that you're favorable towards. Now, apart from that, let's discuss about some of the IT numbers also. We did see TCS showcasing a good deal win, early monetization of AI. Wipro cautioned on weak revenue, and of course, there's an outlook weak for the first quarter. What's your take here? We have HCL Tech, which will be reporting their numbers tomorrow itself. But from an early point of view, what's your take here from the Indian IT sector?
Well, if you try and understand TCS results, TCS has posted a negative growth for the first time in consistent currency terms. So I think TCS is really struggling out there in terms of growth. The revenue guidance is also not is in single digits, I think less than 5%. And we saw Wipro result yesterday. And Wipro announced a 15,000 crore buyback. I think the bigger problem with Indian AI is again, Indian IT is again the same thing that we do not have a pivot towards AI. We do have a certain build-up in AI in these companies, but the massive pivot that we need to match up the global standard, that is missing. And that is the reason why you see Nifty IT is, I think, one of the lagging indexes in comparison to all the other indexes out there. It is lagging more than the benchmark indexes like your Nifty and the small cap index. So I think until we do not have that pivot, I think the growth is not going to be more than 3-4%. And we are seeing major layoffs out there because IT is taking, AI is taking over in IT. So overall, I feel that until we do not stop doing buybacks and rather spend those money on research, it's going to be a tough time for IT. And the price speaks for it. And overall, these are big companies. They're not going to fall too much from here because they've already had their big corrections of around 30% from their all-time highs. They're still sitting at an expensive valuation. But what I feel is that IT would enter into a phase of consolidation, if not a fall. And you look at USD INR right now. USD INR is around 93, and these companies are not able to post a growth in the top line and bottom line where the major revenues are from international clients. So I think once the USD INR, as we were speaking, settles down and moves below 90 levels, it is going to be a tough time for these IT companies to even keep up with the results that they are posting currently. So overall, until we do not have that AI pivot, I think the growth trajectory is going to be anywhere between 3 to 5%, and the kind of valuation these companies are sitting on, I think after every result, it's just going to be a sideways consolidation or a negative view until we do not see that major pivot coming in.
Okay, got it. Harshal, a lot of consumer-focused stocks are back on the table. We have seen that consumer durable stocks are rallying on the hopes of summer season. So currently, how do they look in terms of the growth visibility and from a valuation perspective?
Well, I think they are trading below, I think, their average valuation. So I think they are in a value zone right now. I think they're doing well, and the summer growth demand is also going to put up their top line and bottom line. So overall, I think the consumer durable space itself looks very attractive at the current valuation after the non-performance for the entire 1.5 year, the time correction that we were through, and the current dip because of the Iran and Israel war. Even if you look at the FMCG sector right now, the rural demand is picking up. And I think overall, the growth is bound to come in, and the valuations that they're trading in at are quite reasonable. So overall, I think any dip in sectors like this who have great management, who are picking up the top line and bottom line and a double-digit growth are going to be value buy and very attractive buy at these levels.
Okay, got it. Harshal, let's also talk about some of the paint companies. They have announced a second round of price hikes, particularly Asian Paints, after they announced in April, and then now from May onwards, they've also announced a price increase of 3 to 5%. Do you think these measures are enough to offset any of the margin-related pressures that they are going through amidst this Brent crude price spike?
Well, if you look at both the price hikes, if you discount both the price hikes, they have done a hike of around 10 to 11%. And all the major paint companies are considering because 40 to 60% of their raw material cost, their input cost, is basically from the crude oil. So any spike in the crude oil is going to cause a lot of disruption in their margin. So a hike of 10% is also not really going to solve a lot of problems for them until the crude oil sustains about $95. $95 to $100 is the benchmark line where with the price hike, they're just sustaining. But any hike in the price of crude above this, above $100 or above $95 range, is going to still create that margin deficit for them even after a price hike. So overall, I think that these companies are going to face some pressure. When this quarter results that we are seeing are not going to be into that disruption because the war was just for the month of March. But the quarter one FY27 is going to be the real game where we have to see how this disruption of the Iran-Israel war in terms of the raw material is going to affect the profitability. I think this couple of margin hikes is not really going to solve the short term problem. Maybe in the long term, once the crude settles down, it is going to give them a little good margin exposure. But right now, currently at this price, they still have some gap left.
Okay, got it, got it. Ashral, let's also talk about the Nifty Metal Index. I know you are very excited about this space. It hit a new high a couple of days back also. I mean, at this point of time, when there is a global supply crunch in terms of metals and, of course, aluminium, do you think we have more run up ahead in terms of all of these metal counters that have already seen significant rally?
Well, if you look at metals, metal is a cyclical index in itself, and it's a cyclical sector in itself. So, if you look at aluminium price right now, aluminium prices are at their all-time high because of the supply chain disruptions. Even if you look at copper right now, copper is trading at it's trading close to its all-time high, and this metal cycle just has not started right now. It has started, I think, 1.5 year back. And right now, if you look at the price of stocks, they have finally started picking up. Whereas if you look at National Aluminium, Hindustan Copper, who are pegged to the price of aluminium and copper, they have given a significant move. But I think the kind of move that is loading up in metals right now, they still have a lot of room left. We are expecting a very great result on the front of metal companies. Even if you look at Vedanta right now, Vedanta is blowing off above its all-time high, and we are expecting a demerger to be announced soon in Vedanta. I think overall metal sector, non-ferrous metals, I think as a whole, have been doing really well. Even if you look at gold, silver right now, during the war, the gold, silver should have blown off the roof, but because of the hike in the price of crude, we are expecting the rate cuts to be delayed and we are expecting inflation around. So the rate cuts are delayed. And because of that, we are seeing a correction in the price of gold and silver. And if the war was not around, the gold and silver would also have been sitting at a new all-time high. So overall, I think metal as a space is very exciting. And for another couple of years, it's going to be around. Well, it's not going to be at the magnitude as it is right now. But overall, I think the sector is very bullish because even if you look at markets right now, when the major indices like Nifty, small cap, mid cap, they're trading far below 5-6% from their all-time highs. You look at the metal index. Metal index is trading above the all-time high. Majority of the metal stocks are trading all above their all-time highs. So overall, it also shows that a lot of smart money is accumulating metal stocks, and any ceasefire announcement or any cool down in the Iran-Israel war is going to open up the metal sector to a next level.
Okay, got it, got it. All right, just one last question before I let you go, Harshal. What's your take on the precious metals? That's your gold and silver currently. Because, gold is back above that $4,800 per ounce. And silver is also, rallying softly ahead. But we have seen the kind of correction in the past couple of months. So what do you think the near term holds for both of these bullions?
Well, I think Fed is not hawkish right now. It is in the month of May we are expecting Powell to step down, and we are putting in a new Fed chairman. So I think overall we are expecting rate cuts, not two but one at least by the end of December. So I think the precious metal should pick up soon. The problem here was that central banks, which were a net buyer of gold, have turned into net sellers for the last month because they wanted to hold up a few dollars in their hand to buy up crude. So overall, I think once the war settles down, I think the central banks will be on the buying spree because US is very stretched right now in the war in terms of dollar printing, in terms of loan. There, I think loan is around $39 trillion to the GDP of $36 trillion. It's 110%. So overall, once I think the war is settled down, people will realize how stretched US is, and I'm expecting more correction in terms of dollar index, which is going to be very bullish for these precious metals. So overall, I think that any dovish announcement in the Fed policy is going to boost up the precious metals. Overall, the view remains very bullish. Very rarely you get precious metals in a dip during a war. And this is one of those chances where you get to allocate and where you get to buy precious metals on a dip during a war. Because once the war settles down, we're expecting the buying momentum to continue.
Okay, got it. All right. All right, Harshal, on that note, we have to let you go, but lovely conversation as always.
Thank you so much. Thank you, Navish. It was really nice talking to you. Thank you.
Thank you.